Hello everyone, Dave Landry here from DaveLandry.com, and this is Trading Simplified, episode 31. So what are we talking about? Well, I want to continue my trading rules and hopefully finish them up this week, but I still think I need to do a quick market update, and that's been slowing us down quite a bit. By the way, as I've been saying since we started this show, I do take requests. Just be patient with me to get around to the requests, because there's a lot to cover lately, especially with the market, and also a lot of things I want to cover with trading psychology. If you did want me to cover something more quickly, every Thursday I do a longer show that is free form. In other words, there's no set time periods. So I stay as long as I have to until all questions are answered. If you need the slides from this show and every other previous 30 shows, plus I think my market update's in there too, special market update we did earlier this year, go to davelandry.com/StockCharts, and that includes all the rules to all the setups and everything that I discuss, including some indicators. As you know, or as you may know, everything I do is fully disclosed. No proprietary indicators are used. If you need to contact me, davelandry.com/contact. Now, somebody said that there's a delay in what I'm saying, and then by the time it gets actually published. And that is true. But if you want a more recent update, you can go to my website. And on the homepage, I have bear market updates. And also on the front page, the homepage, I also have the daily market in a minute. Keep in mind that my content for this show, the goal is to teach you something that you could use in future markets and not just tell you where the market is today. And that's known as evergreen content. So even though prices may be at 29.50 or wherever the S&P or whatever other market we're looking at is today, if you follow some of these thoughts in the process and indicators, you should be able to use the same thing or same ideas in future markets. But if you are looking for the latest market updates, see my website. And if you want to see me look at the markets live, then come to the trading shows on Thursdays at davelandry.com. With that said, let's do a quick market update. One thing I've been talking about quite a bit, and I did a little bit of a deep dive on this in a couple of the weekend chart shows, the Thursday shows I just mentioned, where the volatility curve is flattening, and that means that volatility is beginning to come off in this market. Right now, up around 70 is just absolutely ludicrous. I don't remember in history when the volatility has been that high. By the way, I'm using ACP for this particular slide, and I'm using some new indicators, which if you go in and watch last week's presentation, you'll see will be provided for you for free. So what does that mean? Well, volatility can be a bit of a rabbit hole when you kind of start digging into it. And I've gone down that rabbit hole on many occasions. In fact, in the early 90s, I got really obsessed with volatility, and I did all types of studies there. And it wasn't a complete waste of time or an exercise of futility. I did learn a lot about volatility, but it is kind of hard to time a market off of volatility. But there are a few little things here and there that can be useful. And like any indicator, it doesn't necessarily tell you where the market's going, but it does give you some ideas as to what can happen. And as I've been saying lately, as this volatility comes off more and more, we could see a big move in the market. And maybe we saw the beginning of that move on Monday where we challenged the top of the range. And just updating the chart, you could see we are still stuck in the range. And as I alluded to a minute ago, indicators don't necessarily indicate anything. They help to illustrate what's actually in the chart. So far, we're stuck in the range in the S&P 500. And again, if you want to know more about volatility, I did a deep dive last week, and then I'll probably bring it up again this week in the weekend charts on Thursday. Now, just real quick, I want to update you on the 10% TFM system. And here's the rules. We're just looking to buy when the market is within 10% of its 50-week closing high. And we have Landry light on the 50-week moving average, meaning that two lows are greater than the moving average. And we're going to exit when we're more than 10% away from the 50-week closing high, and the close is less than the 50-week moving average. So this is a weekly chart. The green line here is what I call the buy line. As long as we're above the green line, it means that the market on a weekly basis is within 10% of its 50-week closing high. Now, a lot of people often ask me to draw a line on the chart like, okay, what's the line in the sand? Where would it be bullish and where would it be bearish? Well, it's not quite that easy, but that got me to thinking about the fact that if it's above the line in Tarzan speak, as we discussed last week, that is good. And good things tend to happen as long as we stay above the green line. And in Tarzan speak, when we drop below the green line, which means that we're 10% or more away from the 50-week moving average, bad things tend to happen below that line. Now, keep in mind, and this is one thing I didn't think about when I designed this system a couple of years ago and been walking forward with it for the past couple of years, I didn't think that a V-shaped recovery would take the indicator a long time to catch up to. In other words, the indicator won't catch up to a V-shaped recovery if that recovery happens within less than 50 weeks. For instance, notice that the new high we set back in February, that's been about 14 weeks since that happened, and we're looking at a 50-week high. So this buy line is not going to drop for another 36 weeks. So I didn't realize there was that much lag into the system until I actually started following it in real time. Now, lag isn't always a bad thing because lag can help reduce whipsaw, but obviously it puts you in the market a little bit later. Now, if you want to see what that looks like in a more accelerated pace, take a look at the buy line when it comes to a daily chart. Now, I don't follow this system on a daily chart, but you certainly could, and I like to throw out things as fodder for research. I just wanted to show that a simple market timing system, such as if you drop below 10% below the 50-week closing high, the market might be in trouble longer term, can help to avoid some serious spills in the market. In other words, those diaper change moments I've talked about in weeks prior with this TFM 10% system. But anyway, if you take this on a daily basis versus a weekly basis, you can see that this line has begun to drop because we are no longer based on that March high. We're starting to look at these closing highs from late March and then now into February. So on a daily basis, for those keeping score, we actually have a buy signal because we have Landry light, meaning that the lows are greater than the 50, in this case, day moving average, as you can see here. And by the way, if all you did was look to stay short or out of a market when the highs are below the 50-day moving average or your favorite moving average, then as a general statement, you would do fairly well, and as a general statement, you would be in the right side of the market. And by the way, keep in mind that everything works better with trends. So if the market is trending, the simplest of the simplest indicators, something as simple as Landry light, can help to really keep you on the right side of the market. And I don't hate to tease too much, but within the next month or so, we're going to be rolling out some indicators that are going to help you to recognize when a market has Landry light. Go in again and watch last week's presentation, last week at Bandcamp. Anyway, notice that we are above the buy line on a daily basis. So this would be a buy signal based on this system on a daily chart. Now again, I designed this to be a weekly system, but I just want to show you kind of fast forwarding what it would look like in 36 weeks from now when this line begins to drop. And obviously the other way it could trigger would be for the market to rally. Now let's get back to the 12+1 trading rules. The reason it's taken us so long to get through this, in addition to the market updates I've been doing in between, is that I wanted to talk about the importance of trading psychology. And I think what I'm going to do in the not so distant future is to pick apart the peeling of the onion when it comes to trading psychology. So that's the 12+1, that's the 13th rule when it comes to trading. Now, getting back to the rules that we haven't finished yet, number 9 is let things work. Results in trading is often skewed. Most of the gains come from a few big winners. Therefore, it's crucial to catch these occasional home runs. I put out a daily trading service, and I'm not always fantastic with it, truth be told. But sometimes doing really great times, somebody will quit. And I'll say, well, why'd you quit? We're really doing pretty good. Not that we always do this great, but we're really doing pretty good. And they're like, well, I can't make any money. It's like, well, what do you mean you can't make any money? We just had this ABC trade that took off and went up 100%. Well, I didn't take that one. Okay, well, what about XYZ? It's up about 50% right now, not looking too bad. Well, I was in that, but it wasn't really doing much, so I decided to get out. So the problem with trend following, and believe me, I haven't solved for this, and if I ever solve for this, as I often joke, you'll never see my fat arse again, is that it depends on the occasional home run. And I was once told after speaking by a colleague, he said, you use the words streaky in your presentation. That makes it sound kind of elusive. And you know, it can be a little bit elusive. It's not like the guys sitting in their mom's basement with a bunch of fake cash on a mattress and telling you how easy it is to make cash. It could be a little elusive, and you have to work fairly hard at it. So, long story endless, trend trading depends upon the occasional home run. And it's very important that you don't miss those. And many people miss those home runs through the micromanagement of the trade. Now, this is an example that I used way back when I first started doing presentations for StockCharts.com, and this was a TKO in a gold stock, and we had a buy signal, as you can see outlined in the spreadsheet below, with an entry of 350, a stop at 280, an initial profit target of 420. And on the first day and first several days, it felt pretty good to be long, but then the stock began to trade sideways. But here's the deal. Although it didn't hit the initial profit target, it didn't hit the stop either. And you could see that it went for months and months and months and months. And if you follow along in the weekly charts during this period, I kept saying, and I think in also the Trading Simplified shows, that, hey, you know what? This is going to turn into the mother of all don't micromanage examples. And I wouldn't say it was a mother of all examples, but it turned out to be a fantastic example as to why you should stick with positions and follow your plan. Now, what's kind of interesting here is in early 2020, it began to rally up, and it was getting pretty close to that initial profit target. And everyone was starting to feel pretty good, especially since it held on for so long. And then, unfortunately, the stock just began to implode, and you're back to either break even or, depending on what time of day, actually at a loss on the day. And at this point, you're thinking, why am I holding on to the position? It's so-called dead money. Dead money is defined as a position that has no potential for any appreciable gain. Well, how do you know that? You don't. As long as you're not stopped out of the position, continue to follow the plan. So you're probably thinking, F this, and judging from the post in my Facebook group, a lot of people weren't happy with the trade and were thinking about scratching out of the trade. Well, then look what happens. The market begins to take off nicely. Now here's an example on the short side, and there's quite a few, especially more recent times, on the short side that did something similar to this. This one goes back a little bit to last fall, and I think this was probably one of the mystery charts mentioned last fall, so you can go in and check out those shows on YouTube. But anyway, those are the parameters there. We're going to sell short at 45.50, a stop at 53.50, and initial profit target of 35.50. Now, by the way, if you want to look at these archives, you can go to davelandry.com/archives, and you could watch these videos. You can go back and watch the video that I did on September, probably like 12th or 13th, when I first recommended this stock. But you can see we had a nice thrust lower followed by a bit of a pullback. This is a pattern I call a first thrust. We're going to sell short if it drops below this level. We could be wrong, so we're going to put in a stop up here. And then we have an initial profit target of down here. Now the stock bounces around a little bit, but finally triggers. But then what happens? It immediately, after the first day, you felt pretty good, at the end of the first day at least, because it's moving in your favor. But then over the next nearly 2 weeks, it begins to mostly work its way higher. And you're beginning to think, boy, this is a bad idea. I should get out of this trade. Again, it is so-called dead money. And I can all but guarantee that a lot of people did exit this trade when it went against them, especially after being a week or so into the trade. Then, of course, the next day, what happens? It begins to implode and trended nicely lower. And we rode this stock lower for a long time. ACGL, which we're still short, by the way, will be another great example of a potential dead money type of trade. So you do want to follow the plan. Don't get bored or impatient with a trade. And believe me, I know it can be tough. Like Tom Petty once sang, The waiting is the hardest part. And trading, as I've talked about before, you're either waiting for setups or you're waiting for the setup to trigger, and more importantly, sitting in that setup and waiting for it to move. If I had a choice between someone who's smart and someone who's patient, I would take the person who is patient any day of the week over someone who's smart, because someone who's smart is going to try to outsmart the market. Now, number 10 is money management. Trade small, use stops, take partial profits when offered, and trail stops. As I often say, money management will cure a multitude of sins. I have an old car I've been working on and off on for the last decade or so, and it's in storage right now. If you're interested in it, shoot me an email. It's a 1975 Pontiac Granville convertible. But anyway, one day I was working on the engine, reached in and I grabbed something, and I don't have those little Trump mini mints. I have some big manly size hands, and I broke something off, and I went to the auto parts store, and they're like, well, good luck finding that. So I went home and says, well, what am I going to do? Well, I mixed up some JB Weld. It's a bit of a jury rig, but it worked. And when I went back to the auto parts store, JB Weld is this very strong epoxy. It's very heat tolerant, and you could actually sometimes fix metal parts with it. Anyway, long story endless, one of the guys in the auto parts store is like, well, what did you do to fix it? And I said, well, I'm embarrassed to admit. He says, well, come clean. I says, well, I used some JB Weld. And he said, Dave, JB Weld will cure a multitude of sins. And that got me thinking that money management will cure a multitude of sins. It's much easier to follow your trading plan when you're trading at a small size. I often tell people, trade at a size that's nearly meaningless, and you'll find yourself much more likely to be able to follow that trading plan. You won't mentally monetize the trades as much. And I could do a whole presentation just on the fact that many people tend to mentally monetize their trades, and that's when you get into a lot of trouble. Now, again, if you're not losing a whole lot on the trade and you're not risking a whole lot on the trade, it's much easier to hang on when you must. And by the way, some of this presentation, or some of the slides from this presentation, comes from a bigger presentation we did in episode 7 on money management. So I'd encourage you to go in and watch that episode. Now, again, when it comes to mentally monetizing, I could do a whole show just on that. But a lot of times that mentally monetizing will cause you to exit early and miss crucial big winners. You think, well, I could pay off a credit card with this trade, or I just lost enough I could have paid off the credit card had I not lost this much money. I'm just going to get out, or I need the money, so I better get out of the trade. Whereas if you're trading at a smaller size, you're more likely to be mentally able to hang with that position. Now, the bottom line is, if you are trading at a proper size, a small size, a loss is viewed as a cost of doing business. But one thing real quick, whenever I talk about money management, I often have to remember to bring up the point that a good offense is often your best defense. So you have to pick the best stocks going in to a trade. And as I'm going to say in just one second, it always comes back to psychology. And a lot of times people will show me, successful people who are successful in life, doctors, lawyers, automatic transmission mechanics, they'll just show me these mediocre setups. And I'll be like, dude, this market is not even really trending. Why do you want to trade this stock? And I could never figure out why they did that. And I know I've told this story ad nauseum, but finally a psychiatrist who was one of my clients emailed me and said, it's because in the real world, where outside of trading that is, we have to take whatever train wreck comes along. We can't wait around for the perfect car to come in that's easy to fix, or the perfect patient to come in that trying to help him might not make him worse, might just make him worse. We have to take whatever train wreck comes along. So we've had a lot of training for that. And as I preach, a lot of times it all comes back to psychology. And this is why I'm going to do, or begin at least, a deep dive into trading psychology in, again, the not so distant future. Speaking of psychology, Someone once asked me, is your money management based on psychology or statistics? So my answer to that question is yes. Now, getting back to the cocktail napkin, I actually do have these cocktail napkins made, and this is a picture of one of them. And this is pretty much my methodology in a nutshell. We're looking to trade pullbacks in trending markets for the most part. There's a few caveats here and there. Occasionally we look to play some emerging trends or early trends. But again, even then, we're still trading pullbacks. But you're waiting for an entry, and if that stock triggers an entry or whatever other market you want to trade with the methodology, then we put in a stop because we know we can be wrong. Nobody knows exactly what a market will do. Not you, not me, and certainly not that guy who screams on TV. Now, we take initial profits, half, just in case we are right small, and we trail a stop higher just in case that trend continues for a long, long time. Now, there's a few details, but in a nutshell, that's pretty much the money management. So we're trading for both short-term and longer-term gains. So I'm going to let freshman psychology rear its ugly head for a minute. And if we take a look at Maslow's hierarchy of needs, the short-term trading fulfills those lower-end needs, our need for quick gratification, instant gratification, in this microwave society we live in, okay? When's the last time you've seen a video store? They no longer exist. Why? Because we could get a movie instantly downloaded. Nobody's going to take the time to go out and look through movies, pick up a movie, drive back home, and then go return the movie. It's just the society we live in. We expect immediate gratification. Unfortunately, the market doesn't move on our time frame. But by taking those short-term profits, we're more likely to get a short-term profit out of the market than a longer-term profit. Now, keep in mind, by the way, that the only problem with short-term trading is you still can have occasionally big risk, and you can only make so much money over the short term in trading. And that's probably a whole presentation in and of itself. That's why I'm not a pure shorter-term trader, but I will occasionally take some fairly short-term trades. But I always, especially in the swing to intermediate trading, the core methodology is what I call it. I'm always trying to get a home run out of the position, but I'm willing to take those short-term profits just in case a longer-term trend doesn't materialize. Now, climbing up that Maslow's ladder, when you do capture that longer-term trend, you are fulfilling not only your monetary goals, but there is some of that self-actualization, the creativity, the making you feel good, helping your self-esteem out, and capturing those longer-term trends. So the money management is both psychological and statistical. Now, if we're looking at the little pullback figure, again, we're looking to enter, and we're trying to capture that reversion to the mean move in the direction of the trend. Somebody once said, Dave, you always preach against reversion to the mean trading, but you're actually a reversion to mean trader. And we got into a bit of an interesting debate on that. And finally, he said, you're just doing it in the direction of the trend. And I'm like, you know what? He's right. So I do trade reversion to the mean in the direction of the trend. Now, that bounce, if you want to call it that, from oversold back to overbought, especially when you have a solid trend behind you, is fairly certain. Now, I'll use that word kind of loosely there because it's a little hard to quantify. But I can tell you this, the longer term trend from years and years and years and years of research, I started out as a commodity trading advisor in 1995. I think I went full-time in 1994. I'm showing my age here. But I did a tremendous amount of mechanical testing. And from that testing, I learned that there's only about a 28% chance that you're going to capture a longer term trend. But that's where the money is. So you're much more likely to capture that swing trade, and I am slotted as a swing trader, but I will hold positions for a long, long time. But you're much more likely to capture that reversion to the mean move or that bounce from oversold than you are to capture that longer term trend. Now, I can quantify that, or you can quantify that as roughly about a 28% chance that that's going to happen. So 72% of the time, you're not going to capture that wonderful long-term move. But that's okay. That'll put a little money on the table capturing that swing trade. It'll also, again, fulfill some of those psychological needs and keep you in the business. It'll help to keep the lights on until you capture that longer term move. Now, this brings us to number 11, money management. You want to trade small, use stops, take partial profits when offered, and trail stops. Number 12, money management. You want to trade small, use stops, take partial profits when offered, and trail stops. So I know I'm being a little tongue-in-cheek here, but it's money management, money management, money management. Sort of like location, location, location is to real estate. Now, the money management's 90% of trading. The other half, or I should maybe flip that around, half of trading is money management, and the other 90%, to do a yogiism, is psychology. One thing I was thinking about this morning is, again, everything comes back to psychology. And it's vitally important. And so right now, for instance, and this is why it's so important to discuss money management and trading psychology, is these newly minted quarantine traders. And we're going to get into the fact that a lot of people are successful right out the gate, and that could actually be a hindrance to your longer term performance. I'd much rather have somebody who kind of grinds it out for a while. I think longer term they tend to perform better, and there's a William Eckert or two quote on that, and we'll get into that in further presentations. But long story endless, the bottom line is psychology is vitally important, and right now these traders are being trained wrong. And the other thing is they don't understand money management. They wouldn't know money management if it hit them in the buttocks. So I'm going to beat the dead horse on these concepts. Not as exciting as setups. Most people are setup junkies, but it's amazing when someone comes to me after a seminar and asks me a money management question or a psychology question, then I know this trader is working hard to make it and will likely make it, as opposed to a setup type of question. So if you're looking for some follow-up information, DaveLandry.com/StockCharts. I'll give you all of these slides from all the prior presentations, including this one, which includes, again, the system rules, setups, etc. I'll also give you a free market timing course, which uses some of the things that I've discussed over the past several weeks. If you need to reach me, DaveLandry.com/contact. I want to thank you all for watching, and may the trend be with you. And everybody, stay safe and stay sane. Thank you so much.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.